Hi folks, welcome to this video that asks you to prepare translated financial statements for the subsidiary company in the domestic company's currency, which is the Canadian dollar, and you have to use both the foreign currency translation method, FCT, and the presentation currency translation method, PCT. So let's begin with the FCT. That method is probably the more complicated of the two. It requires a little more detail. And so I thought that it might be a good idea just to repeat some of the rules when you're making the assumption that the functional currency is that of the parent or the domestic company, which in our case is the Canadian dollar. That's what the FCT method says. So if we look at some of the rules, don't forget here that the monetary items are translated at the closing rate. That's the spot rate at the balance sheet date. So it's because that closing rate will change from period to period that it gives rise to exchange gains and losses that are reported as part of net income. Your non-monetary items, things like inventory, plant and equipment, those types of things are translated at what we call the historical rate. And the income statement items are translated at the historical rate as well. But if you don't know what that historical rate is, you should use the average rate. So now, in our question here, using FCT, don't forget, we have to look at anything that gives a change in the monetary position in order to calculate any exchange gain and loss that goes into net income. So before we do a translated income statement, we should know exactly how much of a gain or loss would be going into our translated net income as a result of any change in our monetary position. Now, we know in this question that there were some dividends that were declared and paid on September 30th, year 2, but we aren't given the amount of the dividends, but we can work with the opening and closing balances of retained earnings along with the profit that we have that the sub earned in year 2 in order to calculate what dividends were. So we know that our retained earnings at the beginning of the current year, year 2, were 7 million US. We add in profit of 1.5 million, which was given in the question. We can see so far we have sitting in retained earnings 8.5 million. But we also know the ending balance of retained earnings is 7.48 million US. So the difference between what our retained earnings is to date with profit and the retained earnings at the end must be what we declared and paid out as in dividends. And that happens to be 1,020,000. We're going to use this number in order to calculate any change in our monetary position, because don't forget, these are cash dividends. And if they're cash dividends, that means they're being paid out in cash, and cash is monetary. So let's have a look, in order to calculate this exchange gain or loss, let's have a look at our monetary position and what changed it during the year. So our opening monetary position at January 1, year 2 was what? Any of our monetary assets, which in our case here, that would include our accounts receivable and cash of 4.7 million US and 900,000 US, right? And we'll deduct from that our monetary liabilities, which are our bonds payable and our current liabilities that were given in the question at 2.4 million US. So that gives us a net monetary liability position because the monetary liabilities exceeded the monetary assets by 1.6 million. Now, what changed your monetary position from the monetary liability position at which you started? Well, you had sales during the year, and we can see from the income statement that was 30 million US. We can also see here that we had purchases during the year, and we can see from the data in the question that was 23.4 million that was given to us. We also had other expenses. Now, in terms of the other expenses here, we were told those were 3.8 million. In our question. Don't forget, they didn't give us any information on things like depreciation or any of those things that we had to be careful of. So we couldn't, we had plant and equipment at net, so we couldn't separate out, any depreciation expense items, because if we could, we'd be translating them again at the historical rate. but we don't have that, so we're just going to take the 3.8 million as it sits, and again we calculated what our dividends were. And don't forget, these items that have the brackets around them have them because they actually increase a monetary liability position, right? Because they use cash to settle them. So in other words, when we have to pay for our purchases, so that will use cash. We have expenses that we have to pay, that uses cash, and we have dividends that we pay out, and that uses cash as well. So I just put the brackets around it to kind of show that it's increasing a monetary liability position, which is where you started at with a monetary liability position. Notice with the sales, that decreases a monetary liability position because it brings in cash, right? So in any case, we have a calculated monetary position. So as if the parent did it all themselves, it would be 180,000 US dollars. That would be their net monetary position. And you'll see it would be a net monetary asset position because anything that brought in or created monetary assets exceeded those which used up monetary assets, which are the items I'm highlighting here. So we have a net monetary asset position of 180,000. The first thing we need to do before we do any translation on the right-hand side here is we need to make sure that the calculated position, which is the position as if the parent had done all its work in the foreign country by itself, okay, would be in comparison to what it actually is, given that we had a sub in the foreign country doing our work for us. So what would our actual monetary position be at the end of the year? We'll look at the end of year 2 statement, and you'll see here that we have 6.1 million in receivables and 780,000 in cash. Those are monetary assets, and deduct from them any monetary liabilities, which are bonds payable and our current liabilities. And you can see again that your monetary assets exceed your monetary liabilities by 180,000. And these two amounts should be the same. If they're not, you should go back before you do any translating here on the right hand side, just to make sure that you've caught all of the items that give rise to changes in your monetary position. But now that we know we've got this correct, let's go ahead and take all of these monetary amounts, things like our opening monetary liability balance, sales for the year, purchases, and other items here that I'm highlighting that have changed your monetary position, and translate them. Well, don't forget, this is our opening monetary position at the end of year 1, which is the date we became related, and the historical rate then was 1.1. So that translates in Canadian dollars to 1.76 million. Again, your sales, we weren't given the actual rates in effect at the date each sale took place. So we don't know the historical rate, but we do know the average rate. And the average rate in our question was 1.08. So that was our year 2 average. So we're going to translate sales and purchases as well as other expenses at that rate. And don't forget, the rate in effect at the date the dividends were declared and paid was 1.07. That was your September 30th rate. So we're using that rate. So we're going to get a calculated monetary position translated into Canadian dollars of 172,600. If we compare that to the actual monetary position, that is what we get when we go to the subs US statements, right? Translated at the closing rate, because all monetary items are translated at the closing rate of 1.05, that's our December 31st year 2 rate, we would have a monetary asset position of 189,000. So what we're doing here is we're saying if the parent had been doing all of this work in the US, they would have showed a net monetary asset position of 172,600 Canadian dollars, but they didn't do it. They had the sub do it, and having the sub do it created a higher monetary asset position for them at 189,000. So that gives us an exchange gain that goes into net income of 16,400. So we needed to calculate the exchange gain or loss first so that we could actually find that amount to put it on the translated income statement. So now we're going to go ahead and do the translated income statement. So if we have a look there, what do we see? We see here that we have sales of 30 million, which we already discussed. We would translate at the average rate because we don't know the historical rate in effect at the date we made all these sales. We also know purchases for the same reason are translated at the average rate, and 23.4 million again was given to you in the question. Now you might recognize these two amounts here, cost of purchases and changes in inventory. That's the same as beginning inventory plus purchases less ending inventory. So your change in inventory is your beginning less your ending inventory. Those two numbers together will give you your cost of goods sold. But the question gave you this information a little bit differently. So in order to determine change in inventory, you're going to have to look at beginning inventory. So this is basically your beginning inventory less your ending inventory, right? So inventory is non-monetary. So we need to know, based on our rule, what the historical rates were for those non-monetary items. Now, in your question, they do tell you, which is why they've got the little calc sign, meaning that the rate is not any one rate. You need to calculate rates, and the star. And it says, well, let's use the historical rates they give us for the end of year one inventory. Historical rate there was 1.10, and the historical rate at which the ending inventory was purchased, which is sometime at or about the end of year two, is 1.06. These rates are given to you. So we know our change in inventory, which is 600,000, is made up of items that are translated at two different rates. So that gives us in total 888,000, which is our translated amount for your change in inventory. Your depreciation expense here, now we do have some depreciation expense, which is on the income statement here. They give us that. So they told us that that depreciation expense is how much? 700,000. Notice it wasn't part of the other expenses we said before. It's separate. So we're going to translate that at 1.10, which is the historical rate to the consolidated entity. And that's going to give us 770,000. Notice that any of the fixed assets that gave rise to this depreciation expense, because we can see at the end of year one in the statements that we did have some plant and equipment at net as the sub, we know that some of that depreciation expense must have been due to the fact that the sub had some fixed assets before we became related. But we don't need to know what the historical rate was at that date that the sub actually purchased them. What we're doing is we're using the historical rate to the consolidated entity, because we learned that you can't use a historical rate that pre-exists the rate in effect at the date the two entities became related. So no matter what the rate was at the date that the sub actually bought that plant and equipment, which gives rise to depreciation expense, some of which is in here, okay, we can't use whatever that old rate is. So you got to watch these questions, because they could have said that was 1.02 or 0.98. They could have given you something different. But you have to use the rate in effect at the date the two become related, because again, your historical rate can't pre-exist the rate in effect at the date you became related. So this becomes the historical rate for any pre-existing fixed assets that the sub had, and any depreciation expense on those same assets. So again, we would use 1.10, and that's going to give us 770,000 translated. Again, because depreciation is not included in your other expenses, we use the average rate because that's the only rate we have, and we get 4,104,000 Canadian. Notice that we've also added in our exchange gain, and the only reason there's a bracket here, it is a gain, so it's a plus. It would be added into your revenue because it's a credit. The only reason we put a bracket around it is because it's sitting amongst expense accounts. So expenses are debits, the gain we set up as a credit. So what we would see here is that when we translate the position, we get $31,017,600 on all your expenses, including the netting out of the gain. So these guys here, from cost of purchases right down to the exchange gain, give you $31,017,600. And when you deduct that from your sales, you get a profit of $1,382,400. All right. So now we can use that profit to help us calculate our translated retained earnings at the end of year two, and we'll need that because we need to put that in our translated balance sheet. So let's do that. We know that at the beginning of year 2, we have a retained earnings balance of $7 million. That's your ending year 1 balance. And again, because they became related at that date, the end of year 1, we're using the historical rate, and that gives us $7.7 million. We're taking our profit that we just calculated above, translated at $1,382,400, and deducting our dividends, which we translated way back up here, right? When we were trying to figure out a number for our translated exchange gain or loss amount, we took the US amount and translated it at 1.07, and we got 1,091,400. So we're putting that in here to give us an ending retained earnings balance of 7,991,000. So now what we can do is we can go ahead and do our statement of financial position. So don't forget, you have your non-monetary items like plant and equipment and inventory. Don't forget, this is ending inventory translated at the historical rate, and your plant and equipment translated at the historical rate to the consolidated entity, which is 1.1. Don't forget your receivables and cash, they're monetary, so we use the closing rates, and we'll get a total assets of $20,526,000. Now when we look at the liability and equity piece, it's not so bad. We got this number here for retained earnings from what we did up here when we translated the retained earnings statement. We also know the bonds payable and the current liabilities are monetary liabilities. So again, we use the closing rate to translate them. And again, our ordinary shares, they're non-monetary. We use the historical rate to the consolidated entity. And we're going to get a balance sheet that balances to $20,526,000. So we've completed now the FCT, or the foreign currency translation method. In our next part here, part B, we'll go through a similar exercise following some different rules in order to determine under PCT, or presentation currency translation method, how we would translate our statements. Hi folks. In this second part, what we're going to do is do the same thing as we did in the first part of the question and translate the statements, but this time under the presentation currency translation method, which is applied how? All the assets and liabilities are translated at the closing rate. So it's your change in your net assets, or assets less liabilities, that give rise to any exchange gains and losses, and these are recorded in OCI. All income statement items are translated at the average rate. So the first thing we need to do before we can do our income statement, or statement of comprehensive income in our case, we need to make sure that we calculate the exchange gain or loss. So let's look at our opening net asset position at the beginning of year 1, or sorry, the beginning of year 2. So if we have a look at our net asset position, we can actually get that So now in our case here, let's look at the net asset position at the beginning of year 2, i.e. the end of year 1. And if we have a look there, we can see that the net asset position is going to be what? It's 12 million US. So how did we get that? Well, we have ordinary shares of 5 million in the equity section and retained earnings of 7 million. Because don't forget, net assets are assets less liabilities. That's equal to shareholders' equity. So we can just add up our shareholders' equity amounts. Our profit is given to us in the question at 1.5 million, and our dividends we calculated in part A. So our calculated net asset position, because don't forget the declaration of dividends decreases shareholders' equity, right? And profit or income increases it. So our calculated net asset position is 12,480,000 US, as if the parent did it themselves. But they didn't. They had the sub to do it. So let's look at the actual net asset position that we have. And again, we can see here the actual net asset position at the end of year 2 is the same as the calculated. And where do we get that? Your actual net asset position at the end of year 2 would be your ordinary shares plus your retained earnings, which is 12,480,000. Again, if we translate the actual net asset position at the end of year 2, which is the sub's net assets at that date, we translate it the closing rate and get 13,104,000 Canadian. Our net assets here at the beginning of the year, we have to translate it the historical rate. Those net assets were earned by the sub previous to the relationship, so we translate them at the historical rate to the consolidated entity, which is 1.1. Our profit, again, don't forget, all assets and liabilities translated at the average rate, and so profit is at the average rate of 1.08, and dividends, again, the rate in effect at the date they were declared, and that is 1.07. So now, if we compare our calculated to our actual position, we're going to get an exchange loss in this case. Why? Because if the parent had done it all themselves, they would have had a net asset position of $13,728,600 Canadian, but they didn't. They had the sub, Sandora, do it. So therefore, if we look at the net assets of Sandora and multiply them by the closing rate, we're going to get $13,104,000, which is a lesser net asset position. So by having Sandora do our business in the U.S., we have an exchange loss of $624,600. That's going to be included in OCI. But first of all, let's translate the income statement such that we can add OCI to it to get a statement of comprehensive income finalized. So we have our sales, our purchases, our change in inventory, which is part of cost of goods sold, but don't forget, all income statement items, even the change in inventory, which is part of your cost of sales, all translated at the average rate. So don't have to be as fussy here as we were when we did the FCT method. All translated at the average rate. So we're going to find that our profit of $1.5 million translates to $1,620,000. If we add in our exchange loss, we're going to get comprehensive income of $995,400. This now will become part of our AOCI, or accumulated other comprehensive income, in the translated balance sheet. Now let's find out what our retained earnings is at the end of year 2 so we can get to the balance sheet. So we can see here our opening retained earnings at the beginning of year 2, i.e. end of year 1, would be $7 million. How do we know? Again, we would look at the subsidiaries balance sheet at the end of year 1, and we can see the retained earnings are $7 million. If we add profit and deduct dividends, we have $7.48 million in ending retained earnings at the end of year 2, which again we know we have because that should give us exactly what we have in the balance sheet for the sub at the end of year 2, and it does if we check the statements. But don't forget, we translate our opening year 2 balance at the historical rate, which is 1.1, our profit at the average rate, because don't forget we're using PCT, and our dividends, just as we do under FCT, same for PCT, at the spot rate, the date the dividends were declared. So that's going to give us an ending balance in our ending inventory, an ending retained earnings of $8,228,600. And we can use that and put it on our statement of financial position in the equity section. So if we go to our statement of financial position, again, don't forget, it's much easier. All assets and liabilities are translated at the closing rate, and we have that as 1.05 in our question. So we're going to get total assets of $20,139,000. If we look at our liabilities, again, we would translate those at 1.05. And again, don't forget we have our ordinary shares. They will be translated at the historical rate. These were common shares that the sub Sandora had that pre-existed the relationship. But we can't use the historical rate, which is the rate in effect at the date those shares were issued. We use the shares in effect, the rate in effect at the date that the two became related. Now, in this case, it happens to be, because the parent company owns all of it, it happens to be the December 31st year 1 rate in any case, which is 1.10. Your retained earnings we just calculated up here, so we'll bring that down. And don't forget, because we're doing a statement of financial position or balance sheet, we now have to add in an AOCI because we have OCI this year. Don't forget we had an exchange loss that's going into OCI. So we assume, because it's not on the statement that we had any opening AOCI balance, we assume this is the first year we had any OCI, so it's AOCI and OCI are the same, which is $624,600 loss, or debit in this case. So when we add up our total liabilities and equity, we can see it totals exactly what the total assets totaled, and that's 20,139,000 Canadian dollars. So, this concludes our presentation of the question. I hope you found it helpful.